Hi, this is Mike Smalley with Waterstone Mortgage, and this is your mortgage and real estate trends update for Thursday, February the 4th, 2010. As I sit here today, we are rapidly approaching the expiration of the first-time homebuyer tax credit, and we're a short 4 weeks from today to April 30th, which is the last day to write a contract and claim the tax credit. And we're 20 weeks away from June 30th, which is the last day to close to claim the tax credit. Now, there's a date actually a little bit earlier that not as many people are talking about, and that's March 31st. March 31st is the expiration of the Federal Reserve Mortgage-Backed Securities Purchase Program. And if you're not familiar with that, that date is the last day the Federal Reserve will be purchasing mortgage-backed securities. And the Fed's Mortgage-Backed Securities Purchase Program has been their concentrated effort to keep interest rates low over the past 15 months. The chart I'm going to show you here is actually a chart that shows the movement of mortgage-backed securities pricing. And when the price of a mortgage-backed security increases, then interest rates decrease. So if we go back to November of 2008, you can see we had a significant increase in mortgage bond pricing. The catalyst for that was on Thanksgiving week 2008, the Fed announced that they were going to spend $750 billion in the calendar year of 2009 purchasing mortgage-backed securities. The effort was to add stability to the housing market by driving down interest rates. And that announcement was very successful. You can see we had a significant increase in mortgage bond pricing, and rates went from 6.25 into the upper fours, the 4.75 range. Shortly thereafter, interest rates started to increase, bond pricing went down, interest rates decreased up into the lower fives. They did that because the market's just not comfortable with interest rates being at such a historic level as they were for a few weeks in December of 2008. Then in March of 2009, the Fed came out with the second announcement, and that was that they were going to add to the initial $750 billion announced in November. They were going to add $500 billion more for a total of $1.25 trillion of money to purchase mortgage-backed securities in the calendar year of 2009. Again, we had a nice little rally, and rates went back into the upper fours. But shortly thereafter, history repeated itself, and bond pricing started to sell off, and rates went up. And towards the end of May 2009, rates got as high as 5.75%. Now, market factors themselves pulled rates down into the lower fives, but it wasn't again until another Federal Reserve announcement in the fall of 2009 that we saw another significant rally where rates got back into the fours. In the fall of 2009, the Fed announced that the plan that was supposed to expire December 31st was going to be extended through March 31st, 2010. And the real intention there was basically to prevent rates from increasing significantly at the expiration of the program in December. They were kind of easing off the accelerator, so to speak, and they didn't add any money to the pot. They're still spending $1.25 trillion, but they were going to stretch out the remaining money that was left in the beginning of the fourth quarter into the first quarter of 2010. The intention there was to limit the increase in interest rates so it wasn't such a knee-jerk reaction, and that rates would steadily increase over time but not significantly in a very short period of time. And again, that was successful. But bond pricing started to sell off a little bit, and rates went from the upper fours to the low fives. We've actually had a couple good days here in the last week, but bottom line is that interest rates are going up. It's just not a matter of if but when, and to what degree. You've seen many prognostications calling for rates to exceed 6% this year. My personal opinion is that rates will probably be in the mid-fives to upper fives most of the year. I wouldn't be surprised to see rates hit 6%, but as long as the inflation measures that are reported on a monthly basis remain somewhat tame, we should see higher interest rates, but not significantly higher, and I'd be a little bit surprised to see them exceed 6% for more than a couple days, short period of time. Now, in addition to the movement of interest rates, increasing interest rates will also have a direct impact on mortgage payments. And the chart I'm going to show you here is going to show you a direct correlation between increasing interest rates and increasing mortgage payments. Now we've got a lot of buyers that are sitting on the fence waiting for home prices to decline, and this chart's a great tool to use to show them that sitting on the sidelines might not necessarily help them when it comes to their mortgage payment. If you look at a $200,000 price at an interest rate of 5%, the mortgage payment will be $1,074 a month, principal and interest. Even if prices were to decrease 10%, if rates go up from 5 to 6, the principal and interest is $1,079, only $5 more than the payment on a $200,000 loan at 5%. Now, with the expiration of the first-time homebuyer tax credit, if someone were to wait for this 10% decline in price, they're going to see no difference in mortgage financing, and they're going to lose $8,000 of government stimulus. So this is a great tool to show your clients to spur them to take action and purchase a property before the tax credit expires. There's been a bit more news this week. The Federal Housing Administration announced a few weeks back that they were going to waive the 90-day waiting period requirement, or what we call the flip rule, before a buyer can purchase a property, meaning that if someone owns a property, they would have had to have owned it for 90 days in the past before they could write a contract and sell it. That rule has been waived. We were a little bit nervous the past few weeks that some of the banks that we sell our loans to would not follow suit and would continue to stick to the 90-day rule. At this point, none of them have, and starting yesterday, February 3rd, Waterstone is accepting FHA applications for people who do not meet the old 90-day seasoning requirement. I'm going to attach a copy of this 5-page document here because there are some rules and guidelines that have to be met in order to qualify for that. So this document is attached in the email I'm sending you here. Second bit of information that came out this week is the administration released their annual budget, and this is the Mortgage Bankers Association press release, which highlights some things that they feel are very important as it relates to the housing market. At the top here, the Federal Housing Administration is proposing Congress raise the FHA monthly mortgage insurance premium, but at the same time allowing them to decrease the upfront mortgage insurance premium. And the MBA views that as a positive. There are a couple more housing related things that I think are important to point out, and this document here is attached to the email as well. The Treasury has proposed a number of tax increases this year, most notably expanding the marginal tax rates and extending them from the present levels to where they were prior to the 2001 and 2003 tax cuts, back up to 36 and 39.6%. Something important to housing is the proposal to limit the itemized deductions allowed for joint filers making over $250,000 and individuals making over $200,000, taking away the ability to deduct mortgage interest and property taxes and mortgage insurance for people in those tax brackets would be a negative for the housing market, and that's definitely something we've got to keep our eye on. And last but not least, I want to mention two more dates. As you know, we host a seminar every single month, and this month is no different. And on Thursday, February the 18th, we're having Lonnie Young, who's an accountant that specializes in preparing tax returns for real estate professionals, come speak at our seminar. It's at 9:30 at the Winter Park Civic Center on Morse Boulevard in Winter Park. And if you want to RSVP, just send me an email, and I will make sure you're on the list. I've actually added a date in the last few weeks as we have all processed the new Good Faith Estimate and HUD-1 closing statement. I've had dozens of realtors call me with questions about just the logistics of the Good Faith Estimate and when can we send it and what are the things that I have to be careful of and what are the workarounds. So I've decided to host a webinar where I can actually show you what the Good Faith Estimate looks like and how we prepare it. And that's going to be on Wednesday, February the 17th at 10 o'clock in the morning. If you want more information on that, just send me an email and I can get you some particulars. I hope you enjoy this new format that I've sent this in, and I hope the video is educational and informational as always. And hope you have a great week. If you have any questions, just please call me at my office. Have a great day. Bye-bye.